So this is a consolidated statement of financial position. Let's have a read of the question. It's quite simple. The parent acquires 75% of the subsidiary, 75% there, so that means the NCI is going to be 25%. The subsidiary's retained earnings at the date of acquisition is 10,000. And we can see here the retained earnings is now 20,000, so this balance sheet's obviously a little later on than the acquisition date. And it tells us that the NCI contribution was valued as 9,000, and that's an estimate from the directors of the parent. So before we consolidate, we have a couple of workings to fulfill. And the first is working one, which we'll call Goodwill. What goes into Goodwill? The first thing, let's put a heading onto this. First is the contribution from the parent, and that is taken straight from their balance sheet. Investment in the subsidiary, 30,000. That was easy enough. Contribution from the NCI. Now in this question it's given to us directly as a figure, 9,000. So we can put that straight in. So far so good. What have these two organisations purchased for their £39,000? Well, they've bought shares, which we'll put in as 10,000. And they purchased retained earnings at date of acquisition. And let's just make that clearer. Retained earnings at date of acquisition. And that's given to us in the question, 10,000. Oops, 10,000. So between them, the two companies have put up £39,000. They've purchased 10,000 in shares, 10,000 in retained earnings, which leaves a very simple calculation of 39,000 minus 20,000 is obviously 19,000 in goodwill. And goodwill is that indefinable, intangible asset that's realized on some acquisitions where you pay over the odds. And you might be paying for customer lists, you might be paying for goodwill in the community, all kinds of things that are unable to be defined or measured specifically, and they all lump together as goodwill when you pay over the odds. So we now have a goodwill figure that we can put into the consolidated statement of financial position. So let's just label that goodwill, and that's just gone in there as a addition straight from this cell, 19,000 going into goodwill. So that's the first part done. Investment in the subsidiary we know to ignore, so that's 0. And the other assets, that is a simple calculation. Bring the two together, add one, add the other, and we're done. So that's total assets of 97,000. Doesn't look quite right. Let's add in the goodwill. There we go, 116,000 for total assets for the group. Okay, equity shares, as we know, that's the parent only. We ignore the 10,000 as we ignored the investment here. Now, retained earnings, that's going to need a working. So let's do that here. So this is working 2. Retained earnings. And we can look at what we're trying to calculate here is the difference between the retained earnings at acquisition and the retained earnings at the date of the statement. So we can see here that's 10,000, but let's do that neatly in a working. So we have the post-acquisition. Let's move that down. Parent and subsidiary. Post-ac for the parent is 60. Post-ac for the subsidiary is 20. Less the pre-ac amount. So we're going to remove the 10,000, and that's given to us in the question. So that's minus 10,000. That gives us a total amount of 20 minus 10, which is of course 10. And we have to look at, we're kind of looking for the consolidated amount here. So what proportion of these retained earnings post-acquisition are attributable to the parent? And it's the amount of their ownership, it's 75%. So we can say here 75% share of the 10,000 plus 10,000 times 0.75 gives 7,500, which we can then add to our total figure, our post-ac for the parent plus our share of the post-acquisition retained earnings of the subsidiary. So that plus that comes to plus 60 plus 7,500. 67,500, and those are our retained earnings for the consolidation. So we can put that straight in there, 67,500, and we'll just make a note there, working 2, so people can follow where we've got that from. While we're at it, let's do working 1. People can tell where we've got that from. So let's just go through this retained earnings sum again. The post-acquisition profits, that's 60. The post-acquisition retained earnings of the parent is 60. For the subsidiary, it's 20. Let's just highlight those to show where they've come from. We then remove the pre-acquisition retained earnings, and that's given to us in the question. So that's less 10,000. Gives us 10,000 earned since the date of acquisition. So that's a fairly simple sum. We've now got 20. We did have 10, so we've earned 10 in the intervening period. Now, only 75% of that is attributable to the group. The other part is going to be attributable to the NCI, which we'll deal with in a moment. So that's 7,500, and we add that to the parent's own retained earnings, add those two together, and we get 7,000. Sorry, add this and this, and we get 67,500, and that's brought in here. So now we have to make a note of the NCI because they are owed something, and we have to put it on the balance sheet as so that the numbers balance. So let's just make a calculation for the NCI, and that is going to be, let's put that here, NCI amount. And we start off with their original contribution. How much did they add to the business? And that's given to us elsewhere. Well, in the question originally at 9,000, we've also used it in the goodwill amount as 9,000. So I'll just add that in, 9,000. That's pretty clear. And they're also due a 25% share of the subsidiaries' retained earnings post-acquisition. And this is quite easy because this £10,000, which we split 75%, we now have to put the remaining 25% to the NCI. So this is, take that 10,000 times 25%, 2,500. Obviously, this figure and this figure add up to the total post-acquisition retained earnings for the subsidiary. And that's the NCI figure for the statement. Add those two up, 11,500, and we can put that figure straight in here. So 11,500 for the NCI gives, is that correct? No. Make sure that's included. And then the liabilities is just P plus S. And it's always nice to see that the balance sheet balances. So we've done quite a lot here. 116, 116. And we've got the NCI here, which we'll call working 3. Let's just tidy up what we've done. Working 3 NCI. So we've done quite a lot here. First of all, we worked out our goodwill. We took the parent contribution. We took the NCI contribution given to us in the question of 9,000. What did they purchase in terms of known assets? Well, they purchased 10,000 of shares and 10,000 of retained earnings, which was given to us in the question at the date of acquisition, which gave us 19,000 goodwill. So we can put that in there. The other assets was a simple calculation, parent plus sub. Equity shares, parent only, 20,000. Retained earnings required a calculation. It's the retained earnings of, or the total amount for the parent, plus the post-acquisition earnings of the sub, and just the parent's share of that. So £20,000 post-acquisition earnings less £10,000 pre-ac gives £10,000. 75% of that is 7,500. We add that to the parent's own retained earnings to give us a figure of 67,500. The NCI figure, what's their involvement in the whole group affair? We have their original contribution, which is 9,000. That's given to us in the question here. And they want 25% of the subsidiary's retained earnings. So that's the other 25% of this here. Add those together, we get 11,500, which is the total NCI amount, which just leaves the liabilities, which is a simple P plus S. Add that all up. Nice to see that the balancing figures work. Check all the calculations are correct, because we've added in some extra lines here for NCI. We've added in goodwill. So always make sure that we've added everything in. And it seems to balance. So there we are. That's the consolidated statement of financial position with an NCI and retained earnings and goodwill.